In this video, we walk through Handout 10-2, which requires us to record journal entries for a basic note payable transaction. We're going to record the initial borrowing, we're going to record accrued interest at year end, and then accrued interest and the payment of interest at the maturity of the note. We're told that Mumford borrowed $120,000 by signing a note payable on May 1st, 2020. The note has a 5% interest rate and the note is due on April 30th, 2021. The first thing we need to do is record the initial borrowing. We're receiving $120,000 in cash, and of course we've created a liability, notes payable, in the amount of $120,000. So we debit cash for $120 and we credit notes payable for $120. The note doesn't mature until April 30th, 2021, so we won't actually pay the bank or lender any interest or maturity of the note's face value until April 30th. But we've made use of the money for the past 8 months. We've used the money to finance equipment purchases, inventory, receivables. We've basically used it to fund our operations. And because we've used it to fund our operations and generate revenues, we need to record the cost of that borrowing and match it with those revenues. And that's simply the application of our matching principle. So let's take a look at our calculation of our interest expense. We take the face value of the note of $120,000 and multiply it by 5%. If we did that, we would find our annual interest on the note is $6,000. $6,000 divided by 12 months would be $500 per month. $500 per month. We borrowed the money on April 30th, and so, or May 1st, so we've had the money for 8 months. 8 times 500 is $4,000. So essentially we're taking the face value, multiplying it by the interest rate, and multiplying it by the fraction of the year the note was outstanding. So we've got interest expense of $4,000 and interest payable of $4,000. Again, we're not paying the bank today, but we've incurred a liability and need to record the expense. So we debit interest expense for $4,000 and we credit interest payable for $4,000. Now we need to prepare the journal entry to record accrued interest on the note for 2021. We've now used the money for an additional 4 months, the time between January 1 and April 30th. So we've got interest expense of 4 times 500, $2,000 in additional interest expense and additional interest payable. And of course, we record that with a debit to interest expense and a credit to interest payable. Finally, we need to record the journal entry for the repayment of both the note's principal as well as the accrued interest. So we're going to reduce our liability for interest payable by $6,000 because we're going to now pay that $6,000 in interest. We're going to reduce our notes payable by $100,000 because we're going to pay the face value of the note. So the lender will be expecting $106,000 in cash. And our journal entries are simply a debit to interest payable for $6,000, a debit to notes payable for $6,000, and then our credit to cash for $106,000.